Executive English, DPI, TVPI, RVPI, explained simply. Welcome! Today we're demystifying DPI, TVPI, and RVPI, the core performance ratios in private equity. These multiples translate complex fund activity into clean signals: cash returned, total value created, and value still on the books. If you manage a portfolio or sit on an investment committee, these metrics let you compare funds, vintages, and strategies without getting lost in the weeds. Think of them as a dashboard. DPI tells you what's come back, TVPI shows the full picture, and RVPI reveals what's left to realize. Master these, and you'll make faster, sharper allocation decisions. DPI measures how much cash has come back to investors relative to what they paid in. Formula: cash distributions divided by total paid-in capital. It focuses purely on realized returns, money actually returned, not paper gains. That makes DPI a strong indicator of liquidity and a fund's ability to return capital. Example: DPI equals 0.8x means investors have received 80% of their contributed capital back. In board terms, how much have we gotten back in cash so far? High DPI is comforting. Low DPI early on can be normal depending on strategy and fund age. TVPI shows the complete value created per dollar invested. Distributions plus NAV divided by paid-in. It captures both realized gains, cash out, and unrealized gains, current NAV of remaining assets. Use TVPI to judge the overall multiple potential of a fund, not just liquidity. Example: TVPI equals 1.6x means for every $1 invested, there's $1.60 in combined realized and unrealized value. TVPI is your total pie view, great for benchmarking managers and assessing whether the strategy is meeting underwriting targets. RVPI isolates what's still on the books, NAV divided by paid-in. It measures the unrealized portion of value, how much of investors' capital is represented by remaining holdings. A high RVPI isn't good or bad on its own. It may signal a younger fund, a buy-and-build strategy, or assets held for timing. Crucially, these ratios tie together. TVPI equals DPI plus RVPI. So if TVPI is 1.7x and DPI is 0.6x, RVPI must be 1.1x. Use RVPI to gauge how much value still needs to be converted into distributions. Interpret the signals as a set. High TVPI with low DPI suggests strong value creation that's not yet realized. Expect exits ahead, but watch NAV quality. Rising DPI with falling RVPI indicates the harvesting phase. Assets are being sold, cash is coming back, and the book is shrinking. When two funds have similar TVPI, the one with higher DPI offers stronger liquidity and lower reliance on future exits. Always ask, where is the value? Already paid out, still a NAV, or a balance of both? That context drives risk and pacing decisions. Expect the J-curve. Early years show low DPI and building RVPI as capital is invested and fees accrue. Over time, successful funds convert RVPI into distributions, pushing DPI higher. Older funds should generally show higher DPI, all else equal. But timing matters. Use multiples alongside IRR to understand the speed of value creation and cash return. A 1.6x TVPI with a modest IRR might mean value arrived late. The same TVPI with a strong IRR signals faster cash generation. Multiples tell you the how much. IRR adds the how fast. Before comparing, ensure consistent treatment of fees, FX, and recallable capital. Small differences can distort multiples. Remember, NAV involves judgment. Valuation methods, market swings, and manager optimism can inflate RVPI. Stress test with haircuts or public comps. Compare funds within the same vintage year and strategy to avoid life cycle and risk mix bias. Also watch for subscription lines masking timing. Borrowing can delay capital calls, affecting paid-in and early multiples. Clean inputs and apples-to-apples comparisons make these ratios meaningful. Summing up, DPI shows cash back to investors, TVPI shows total value, and RVPI shows remaining value in NAV. Keep the identity in mind. TVPI equals DPI plus RVPI. If it doesn't foot, something's off. Track trends over time, not just single points. Rising DPI with stable TVPI means value is being realized. Flat DPI with rising TVPI means growth is mostly on paper. Pair multiples with IRR and strategy context to judge pace and risk. Use this trio as your quick, reliable dashboard for fund monitoring and allocation.